I think this is worth talking about. So this has been popping up in the chat a lot. I see people bringing it up, and I actually have some screenshots sent to my Discord saying that TD is reporting that AMC actually closed at 1401. This is interesting because I've seen this discrepancy with AMC 2 days in a row now, where they claim it closed at a lower price than it actually did immediately at close. So that's very interesting. I've got it pulled up, and right here, according to TD Ameritrade, it says 1401 was the close.
And we have people in the comment section specifically talking about that they just got off the phone with TD Ameritrade and seeing 1401. I wasn't sure if I wanted to talk about it until Trey brought it up. Trey, what are your thoughts? What is going on? If this is a repeat offender, what's going on here?
I don't know if it's necessarily a repeat offender, but I think what's going on is some misrepresentation of information from different brokerage firms. And I don't know what that would look like, how they've been doing it, because I haven't seen that happen until the last 2 days. The last 2 days now, I mean, AMC supposedly yesterday closed at like $13.95, and then half an hour later on Webull, it updated to $14. It updated to a $14 close. Now, it hasn't done that quite yet. I'm looking at Webull right now, and it says that it still closed at $13.93. But people said they called TD Ameritrade and that it closed at 1401. In which case, if that actually happened, you would have an additional 29,800 contracts that expired in the money. And that would change the game a lot.
So just to reiterate, we're talking about a discrepancy in the price. First of all, we saw the discrepancy in the close price of GME. We saw it at 202 and change on Webull, and then it changed to 227. That's a $2 difference on Webull, and they were seeing that difference across a bunch of brokers as well. Now we're seeing that discrepancy in TD Ameritrade, showing 1401, which would be completely different than the sub $14 mark that we have here in 1393. We just had Trey's thoughts. What about Max? What do you think about that?
Yeah, I mean, so does that mean the 28 million shares, or wait, no, 2.9 million shares are actually executed, or we have to wait for final confirmation?
I'm interested to see. I don't know, because I'm reading through the chat right now, and some people are saying different numbers. Like some people are saying 1393, some people are saying 1401. Like different brokers are showing different numbers. So I'm a little bit confused, to be honest with you. Hypothetically speaking, if it closed over 14 bucks, it should be 29,800 shares or 29,800 contracts that expired in the money, which would be 2.9 million shares.
See, that's frustrating in itself. Like I'm on Webull here, it says 1393 for close for the day. It's like, how is the spread here 10 cents? That's like a very significant portion. Imagine someone who's buying 100 shares. That's a big difference in price just for buying and selling, the spread.
Exactly.
That's a good freaking question, man. That doesn't make sense to me.
So
that actually brings me to Robinhood. I've seen this pop up with Robinhood a lot, where people will put in a limit order, let's say $10, and it'll fill at 1010 for a limit order. That could be a big difference. Like you're saying, if you're playing with 100 shares, 200, 300, 400, and if it fills you 10 cents higher, what? That doesn't make any sense at all. That's a great question. I don't know how that's possible.
And people were saying that
Robinhood.
Oh, sorry, Max.
I was just going to say Robinhood definitely. Like if I feel like with Robinhood, someone can verify this, but if you're buying a large amount of stocks, I think Robinhood or any other free brokerage probably isn't the way to go because of the pay for order flow. Just inherently, you're not getting the best price because there's at least two intermediaries making money off of the spread, where if you're paying that $10 fee or whatever, you're only paying $10 for the transaction. So I have a feeling if you're buying, I don't know what the total amount needs to be, but like 1,000 shares, it's probably cheaper to use a brokerage where you just pay $10 or whatever.
Boom. Max is putting it right on the money. That's right on the money right here. Payment for order flow. Exactly how are you getting screwed over by selling your data? And essentially, this is the analogy that people have done in Congress, right? They're saying that you are trying to sell a house, or you're trying to sell cupcakes outside your place, whatever, doesn't matter. And you put your price right here in front and say, I'm selling these cupcakes for like $100 a cupcake, right? That shows exactly your willingness to sell, your willingness to pay. And then someone down the street, the high frequency trading algorithm, looks at your price and says, yeah, I'll bid you. Or at the very least, I'm going to work against you. And this has happened through proof that they see that Robinhood gets better revenue if the spread is higher, if the discrepancy between the best price and your price is greater, which means you get a worse deal. When Robinhood goes down, and this is proven in Congress, that they say when Robinhood is offline, everybody sees a lower spread. Everybody gets better prices overall. Like, come on, how crooked can you get if it turns out that your product goes offline and everybody else benefits from that?
Yeah, I mean that was a big question with Citadel in the I can't remember the CEO's name, Ken Griffith,
Kenny
I
G,
think.
yes.
He kept on getting questioned during that first hearing, like asking how could you possibly say that a customer of Robinhood gets the same or better price as another brokerage who you're not paying for order flow, because there's this conflict of interest here where of course you're going to give the Robinhood trader a worse price because you make the money off of that difference in spread, where the other brokerage, it's a reverse relationship. So you actually have an incentive to give the best possible price. So obviously there's some kind of malincentive here.
It's profitability, they're trying to do, I think, what they can to make money on pretty much every single trade. And I don't think it's illegal by any means, but it's incentivized for sure. Why fix it if it ain't broke? I mean, if you're making cash, that's the whole point of the brokerage firm, is to make revenue,
And the thing about payment for order flow is that it could easily be passed on to the person using the broker, right? If you're making money off of my data, and this was also brought up in the congressional hearing, just go ahead and pay me, right? I don't mind that you're making money off of my data. Well, maybe some people mind, but I don't mind if you pay me. That would make me perfectly content, and at the very least would disincentivize you from screwing me over. If every time you get paid for a higher spread and makes me a worse deal, I get paid for that deal.
Or hey, I mean, give the user the option. So it's like, okay, we use payment for order flow up until the fee hits $10. Once it hits a $10 fee, it's just a flat fee, something like that. So then the small orders still have lower fees. It makes it more accessible to smaller traders, and then large traders aren't getting, bent over the barrel either.
And this is where we're getting to with what Max just said, giving us the option, giving us choices. Oh no, choice paralysis, but it's this crazy irrational territory. However, once it's been spoken up in Congress, it is no longer crazy. It's just plain rational. This is just plain exactly what should be happening. Well, once again, people, just to bring it up, Robinhood being real sketchy. People were talking about their call options being executed like an hour before the end of the day, just because they were in the money and even without the permission of the person. Trey, you're nodding your head. Have you heard about that?
Yeah, I had like 10 people super chat that, and like probably 100 people drop that in the chat bar like, what the heck just happened? My freaking call options just got exercised or sold, both, if they were in the money or out of the money. Robinhood was just like, yep, hour away from the gun, we're going to pull the trigger. And some people told me that it got executed or sold at the lowest point of stock price. Let me check on what the price action looked like at the hour before the close. But I think that would be, let's take a look, a quick peeky weeky, as people always say on my channel.
Peeky weeky. Yeah. Have you seen that Teletubbies meme of us? Peeky weeky.
No, I haven't. No. I haven't seen that.
I'll send it to you in a sec.
All right. Yeah, some people told me that they got executed or sold between 1373 and like 1380. So like the lowest point on the day, which is insane. That sucks. And I think I understand why. I mean, I've seen the email that's floated around from Robinhood. They said, sometimes we reserve the right, if we have to close you out of your options or your derivatives if we think that you're either A, not going to be in the money, or B, not have the collateral to exercise your option. So I think that's likely what happened there, but it's still pretty sketchy. I mean, you got to read the fine print sometimes with what you're agreeing to with your brokerage firms.